verlieren sie gegen Köln und verlieren gegen Mainz, weil die stellen sich hinten rein, oder?
Oh. So, ich glaube, auf YouTube streamen wir auch.
Streaming is on.
Hi, Lito.
Hallo miteinander.
Hallo?
Da kommt er. Der Vater, der Dr. Vater.
Hallo zusammen.
Hallo. Wir hatten schon das wichtige Thema abgehandelt, nämlich die Bundesliga und den Pokal.
Okay.
Hat sich verpasst.
RWE böse beschissen worden.
Wirklich. Also Walter sagt, jetzt kämen 3-0, oder? Weil die Bayern haben Dortmund 6-0, 5-0, 4-0 besiegt, jetzt kommt 3-0.
Würde ich sofort unterschreiben. Wenn, ja. Ich bin da nicht ganz so pessimistisch wie er oder optimistisch als Bayern-Fan.
Ja.
Karl, denkst du, Bayern gewinnt wieder Champions League?
Ja.
Ich glaube, Manchester City macht es diesmal, oder?
Oder PSG, die sahen ganz
Meinst du?
stark aus gegen in Barcelona. Aber Barcelona ist ja auch nicht mehr das, was es mal war.
Ja, mit 1,7 Milliarden Schulden.
Genau. So, wie läuft das bei euch?
Nein, wir sind bei euch, weißt du, wir sind offiziell der BWL.
Ja,
du musst die Regeln sagen.
Ja, aber ich will ja nicht jetzt irgendwie böse Überraschungen sagen.
Also was ich vermeiden möchte, ist, dass der Alex da jetzt durch 3 Paper durchhechelt und wir keine Chance haben zu diskutieren, oder?
Genau.
Und da denke ich, soll er das Paper, was er am interessantesten findet oder vielleicht sogar das, was er alleine gemacht hat, mehr vorstellen als die anderen.
Bin ich auch dafür. Genau,
Okay.
Die Policy habe ich auch immer.
Sehr gut.
Okay. Dann teile ich mal schnell die Präsentation und dann wechsle ich auf Englisch.
Ja.
Gut. Ganz auch bayerisch.
Okay. Könnt ihr denn die Präsentation sehen?
Ja.
Okay, great. So, welcome everyone to the PhD defense today on my essays on currency. Thank you very much for your attendance. Also, I'm very appreciative of you guys taking your time and being here. Humbled for this opportunity, of course, and I know that it's a very special time, right? So in this time here, doing this via online, via Jitsi or Zoom or whatever, it's a bit strange, but it's obviously fitting for the strange times we are in, right? So I'm gonna jump right in. I prepared a little presentation. I also thought the same. I thought that I'm gonna go through the first and second paper very briefly, just tell you guys in attendance what they are about and what the main results are, and then I'm gonna mostly focus on the third paper, and hopefully we can get a discussion going on that one. And I'm sure there are questions, and I hope and I'm happy to answer them. Basically, the overarching theme of my dissertation are currencies, right? So hence the name. And my first 2 papers mostly focus on fiat currencies. This is because I worked with fiat currencies in my former job for a macro hedge fund for Peter Püringer. And my last paper put more an emphasis on cryptocurrencies, also because I worked with cryptocurrencies in my startup Alethina. And yeah, like I said, so the reason I started looking into fiat currencies was mostly because I came in contact with them with work and saw at first hand how portfolio managers analyzed fiat currencies and worked with them and made investments accordingly. And yeah, so my first paper was then also together with Tim. Shout out to Tim. I don't think he could make it today, but it was a paper about mean reversion properties in real effective exchange rates. And so in recent years, advances in the field of unit root tests helped to solve or partially solve the first PPP puzzle, right? And those are the nonlinear mean reversion tests I'm talking about. But the problem was that those papers mostly suffered from small sample and sensitivity to the choice of numeraire, because the rear was always against the US dollar, right? So what we did and what we observed was that most macro hedge funds actually used the real effective exchange rate because it's insensitive to the choice of numeraire. And they use it as a value signal. And then we also made a very large sample of 96 currencies, including emerging and frontier markets, which are mostly used for currency carry trade. And therefore, it was very important to analyze the mean reversion properties in those countries. As you can see, those are just a few country end results we had. I'm not going into detail. But on the right-hand side are more the newer test frameworks, the nonlinear tests, and the most significant tests for low-income countries are those nonlinear tests, right? Those are the advances I was talking about. And the most promising ones were always the ones that we made a Fourier function of the real effective exchange rate. And you can see that in some countries, the fit was very good, right? For instance, here in Brazil, on the top left side, and in some other countries as well. And so in a nutshell, we show in the sample of 69 countries that mean reversion is indeed present in approximately 60% of the cases, depending on the underlying time series model. And with this in mind, we argued that REER could be used as a value indicator for FX rates, what we actually observed in our daily work with Püringer. Then we took this a little bit further because it was not only important to know about the mean reversion, it was also important about the speed of mean reversion and the symmetry around the long run mean. So I did then with Florian, my other colleague from work, I did a follow-up paper that was coined What Flows Around Comes Around. And we investigated mean reversion properties using quantile autoregression, right? And this led us to analyze the mean reversion properties depending on the on where the rear is and the deviation from its long run mean. So the condition of the shock size was conditional on the shock size, and this allowed us to come to different kinds of conclusions or go into more detail. And we also found out that in this sample, 13 of 29 countries showed mean reverting tendencies depending on the shock size. And it was also revealed that there was asymmetry. So depreciated currency behaved much differently than a very large appreciated currency. And there was also some other nice things we figured out there, right? And this you can see here, for instance, just in a nutshell, that on the right-hand plot, the most extreme quantiles on the left side and on the right side, this is where the speed of mean reversion is the highest, right? So the farther away you are from the mean, the faster you revert back to it. And this led in most extreme cases to half-lives of just a few months, right? This is what we see here on the half-life and the most extreme quantiles. It is here 4 months and here 8 months. And then lastly, we tied all those to portfolio flows. We analyze portfolio flows that are non-resident purchases of assets, debt securities and equity securities, and showed that conditional on the level of the deviation and shocks incurred, international investors buy those securities, and then the rear reverts back to its mean. And in the most extreme quantiles, the flows move the rear back towards its mean, 1.78% per month. So those are really briefly the first two papers. I also presented them before in some setting. A few of you guys heard that as well. And now I'm going to go into the third paper. It's the most recent paper. I chose that because it's also from the topic very in the news, because it's about cryptocurrencies. It's also a paper I wrote myself, so I think it's best fitting if I get into detail with that one. And so the basis or the motivation for this paper actually comes from a paper from Barberis. He looked at the stock, or they looked at the stock market, and they developed a prospect theory model for the stock market where they valued stocks, single stocks that is, with a prospect theory value function that they developed. And I thought this paper was very intriguing because the underlying model was actually quite simple. It only used price data. And at that time, I was very much into heuristics, and I thought that this was a very good example of a simple model that actually yields great results, right? They used US stock data, but also had international evidence in there, and they showed excess returns of up to 1.35%. And first, I tried to actually do this for fiat currencies as well, right? Me and Tim, we applied the model and looked at fiat currency. We used actually forward data. As you can see here, we did it for 10 currencies. Those are the most, some G10 currencies, but also some emerging market currencies. And we came to the conclusion that it doesn't really work for fiat currencies. As you can see here, the returns aren't that high. I don't think they're significant. So it led us to the conclusion that for fiat currencies, especially forwards, the kind of investors that buy those securities aren't the same investors on average that buy the stocks that Barberis use in their analysis, because individual investors are the ones that the prospect theory value model works best for, or securities that a lot of individual investors buy. They also show that it's that they analyzed that in their paper, and for those fiat currencies here, those are mostly bought by institutional investors, for instance, hedge funds, and I know for a fact firsthand that those hedge funds don't just look at the price chart and analyze it in a way that the prospect theory value model of Barberis assumes, right? They have more sophisticated models, they have more access to data, they have more access to securities, to different kinds of securities that normal people don't have. They have ISTAs. So it's a little bit of a different kind of market. Therefore, it was in the end of no surprise that this didn't work, right? But then I think it was like a year later, I had the gut feeling that actually this could work perfectly for cryptocurrencies, because in cryptocurrencies the story is again a lot different. Cryptocurrencies don't really have, at least in the beginning, a lot of institutional investors. There are a lot of retail or individual investors in the cryptocurrency market, and they actually, most of them don't really have data of the currencies they invest into. They just have price data. They can look at some charts, maybe read a white paper, yes, but there's a lack of fundamental data about the currencies they invest. So I thought that the model itself lines up perfectly with the cryptocurrency market, right? So to get into detail how this model actually works, and I think a lot will make more sense after that. So what they did for the stocks is that they argued that especially in the time before the internet, investors looked at price charts they found in investment books, in stock books. For instance, Value Line was one of those, and they formed some sort of opinion on the return distribution they saw on those charts, right? They made like a mental valuation, so to speak. And then on those stocks, and then they allocate the money to those stocks that seem appealing to them given their mental representation and valuation of that stock, right? And they sell those stocks, and then they buy those stocks that they have a high valuation on, and then they sell those stocks that have a low valuation on average. So their argument is, on average, the prices of those stocks that have a high prospect theory value should rise, and those of a low prospect theory value should fall. And therefore earn high or low subsequent returns. And they do find empirical evidence in favor of this hypothesis. And the story for the cryptocurrencies is actually the same. So I formulated the same hypothesis for cryptocurrencies, that cryptocurrency investors look at the price chart of cryptocurrencies, or for instance on CoinMarketCap or CoinGecko or whatever. And since there's no fundamental data, they just form an opinion on those price charts, and they make an implicit valuation on, and then they buy those cryptocurrencies that seem appealing to them based on that valuation. The underlying prospect theory model is just standard Tversky-Kahneman. It's a cumulative prospect theory with the value function and the probability weighting function. The probability weighting function looks a little bit clunky. I get that. It's like this chart, it becomes a little bit more clear. That's the functional forms, right? So you have the value function with, of course, the gains part and the loss part, and then you have the probability weighting functions, and then the parameters used in the model. Those are the standard Tversky-Kahneman. Just already a side note, I did vary those parameters. Later on, I'm going to get into detail how this looks. I think this will be one of the more interesting discussion points we can have later. And here is a graphical representation. So on the left-hand side, this is, of course, the famous prospect theory value function. We all know that, with the gains part and the loss part, with the reference point here being 0. And the kink around the reference point. And on the right-hand side, we can see the probability weighting function with the dashed line, 45-degree line, being when there is no distortion, and then the other lines when we include distortion, and so to speak, the probabilities are being weighted. So subjective probabilities. And how do you then get a prospect theory value, or how is the prospect theory value calculated specifically? You take the returns of the assets. Here it is the cryptocurrencies, right? You take returns of 30 days, and then you rank them in ascending order. R minus M being the lowest return, and Rn being the highest return. And then you put all this in the prospect theory, cumulative prospect theory function, with the value function of the returns and the weighting function as it is shown here. Also, a side note, I did do this analysis with normal prospect theory. Thorsten was very happy about that, to challenge this a little bit. And the results are quite the same, so in the same range. I mean, of course, not exactly the same, but you can tell it's really in the same range of cumulative prospect theory. Then then what I also did, and this was very important to me, in order to really properly assess the risk and return properties of this strategy, of this prospect theory value strategy for cryptocurrencies, I had to have some sort of factor model because I wanted to do a comparison also to the stock market analysis. And yeah, so it's not like there's a factor model like Thoma and French where you just like can download the factor data and run your regressions. Because obviously the cryptocurrency research is a newer field and there just hasn't been an established model yet. So I looked at the cryptocurrencies, the statistics of it, and it can be seen that there are some statistical similarities to stocks like leptokurtosis, heteroscedasticity, long memory, and but there's the problem. Like I said before, there are no fundamental data on cryptocurrencies, right? So there's not like a dividend payouts or interest payouts that you could do a cash flow analysis on and derive some sort of present value or something like that, right? That's just not the case for cryptocurrencies. So there's lack of fundamentals. So I had to do something else with price data and also market capitalization data, and I derived on 3 factors. That is the market excess return, a size factor, and the momentum factor. I downloaded a lot of data and I calculated those factors. I followed the Thoma-French principle of doing double sorts for the factors. So for the small minus big, of course, there's a small and middle and big portfolio, and then I arrived this in the same way, in the same fashion as Thoma-French did their 3-factor model, right? And those are basically the 2 main regressions for the 1-factor model above. That's expression 8, and for the 3-factor model, expression 9. With this, I was able to then do some factor analysis as well and make proper risk-return performance analysis. Just a side note on data, I got all my data from CoinGecko. I programmed an API with Python where I was able to download all the price data in US dollar of all the cryptocurrencies listed there, both active and defunct ones. This just rendering all concerns of survivorship bias null. Daily volume and market capitalization data was also very important for building of for instance, the size factor, but also other variables I used later as controls. The time span was from 2014 to 2020, and I had some requirements on size, on market capitalization, and on time length of the price history, right? And at the end, I had a final sample of 1,313 cryptocurrencies. When you look at the summary statistics, I think here it's starting to get interesting, right? We know that the prospect theory value of an asset increases in the asset's mean, decreases in the asset's volatility because of loss aversion, and increases in the asset's skewness because of probability weighting, right? And this here actually shows that the prospect theory value, PV, here correlates with past return measures, return and momentum positively. It negatively correlates with volatility measures. This is the standard deviation here, and min-max, and it positively correlates with skewness here. And I think this as a first result, this was very interesting to me to see, okay, the sort of like the first mini evidence that this could actually work for cryptocurrencies, right? And then I did a portfolio analysis on deciles. So I took all the cryptocurrencies, I calculated the prospect theory value of all the cryptocurrencies for every day which yielded a time series for every currency of its prospect theory value. And then I sorted all the currencies into deciles based on their prospect theory value. And I did actually a return analysis and factor analysis then on all those portfolios. I did value weighting and equal weighting. Equal weighting, of course, being every currency has the same weight in the decile, and value weighting is the weight based on its market capitalization. On the right-hand side, the low minus high portfolio is actually the most interesting because it directly ties into the hypothesis of the paper, right? That high prospect theory value stocks should have low subsequent returns and vice versa. And it can be seen that returns, and those are monthly returns, daily returns, net of transaction costs, are quite high actually in percent, right? They are higher for value weights than for equal weights. And you can see that the alphas, the 1-factor alpha and the 3-factor alpha, are also very high. So this was sort of like, I was a little blown away by this. There were questions in my last presentation on the persistence of all this and the turnover in the portfolios. I actually did calculate this and added it to the paper. Very grateful for this comment. I think it's a very legitimate one. So I can tell you that the turnover is in the middle deciles. So for not the edge deciles, is actually quite high with 80 to 90%, right? And on the edge deal size, however, it is considerably lower with like 26%. And on average, a cryptocurrency switches deciles 160 times for the entire duration of the sample, which is over 2,000 trading days. And this equals 7.2% of the time it switches a decile, or every 14th day. And since prospect theory value is calculated using 30 days, so it sort of like stays for 30 days in the calculation and then switches. Here I plotted the alphas that we saw in this table here. I plotted it, and you can see clearly that the trend from low to high PV is almost monotonically decreasing, right? And here I think this is also very interesting. It is the performance of the long-short portfolio. Also, this is alphas here again, 3-factor alphas. It's the performance over time. So you sort of like have the signal at t-1, and on the horizontal axis, it tells you when you're starting to measure returns, right? So when you start measuring returns at t, those are the results we see in this table here, right? And then what this tells you is that the prospect theory value retains its predictive power even a few days after the signal comes in. Here we have it for the value weighted returns, right? So here we have it like up until t+6. This is when I stopped doing the calculation, but it's encouraging that even 2 or 3 days after the signal comes in, PV still has predictive power.
Can I ask a clarifying question?
Yes.
So on the y-axis, what is the scale? Is it percentage per day or per year, or what
Yes,
is 1, 2, 3, 4?
This is a percentage per day net of transaction costs. Those are the alphas, the same as we have here.
Okay. Yes, thank you.
So yes.
Yes.
Can I also bother? So what's your interpretation of the fact that the distance between the two is more or less always the same between the two curves?
Yes, I think that the big cryptocurrencies, the one with the high market capitalization, are the ones that most investors have easy access to. Most cryptocurrency investors, those are the ones that always show up on top of every page. Those are the ones people talk about, and I think it's those that seem most appealing to investors, right? And because they have most easy access to this, they have the highest trading volume as well. You can see this in the correlation table. So I think this explains a little bit why I think this works better for value weighting as for equal weighting. Why the difference is actually always the same. So the difference between value weight and equal weight is roughly 4%, right? Or in the beginning it's a little less. For T it's like, I don't know, 3%, and then it's getting a little bit bigger. I don't know exactly. I just think that the value weighting works better because those are the stocks that the access for the investors is more easier.
Yeah, but based on that, I mean, it seems like, there is one of these currencies. It has a high weight in your portfolio. It's done 4% per year. 4% per day. Sorry, on average, and it happens to always be in the top portfolio. So how big is the turnover?
Yeah, this is what I said before, right? So the turnover, I have it right here. So the turnover in the edge deciles is 26.6% of the entire decile is turned over every day. And for the 10th decile, it's 32.3% every day. And when you look for each current cryptocurrency on average, when you want to know how much each currency changes a decile on average over the entire lifespan of the sample, it's 160 times of the entire duration, which means on average every 14th day it switches a decile. Is this? I know that you were the one who gave the comment on the persistence and turnover, and I had a look at that and I calculated that and I added it to the paper. I think it was a very valuable comment. And does this answer your question regarding the turnover?
Yeah, I just find it strange if you have this thing is so persistent, right?
Mm-hmm. Yeah, what was your expectation on the persistence of those deciles? Did you have some sort of expectation?
Well, I'm just saying, if you have something, I mean, right? Because this is T+4, say, it's I observe the signal today and I look at the return 4 days later, right?
Mm-hmm. Yes.
And that's not cumulative.
Yes, that's in 4 days.
So if it's more or less constant at 4%, I mean, to me, this suggests there is one thing that has a big weight and that happens to have a mean of 4%, and that's always in that portfolio.
Which might be Bitcoin, huh?
Huh?
Might be Bitcoin.
Yeah.
Yeah.
So I don't know, is there one of these currencies that's always in the top portfolio? I mean, almost always.
I checked that Bitcoin is not always in one portfolio. I did check that actually.
Okay.
What I could do if I wanted to develop this paper further, what would actually be good is I could sort of like take certain currencies out. For instance, do the analysis X, Bitcoin, Ether, and Ripple, for instance, the three largest. I mean, Ripple is not the largest anymore. It's actually Cardano, the third largest. I'm sorry.
Yeah.
But
yeah, that would probably make sense, right? Because one worry with the value weighted is that a couple of these things dominate, right?
Yeah. Yeah, so this would be actually a nice addition then, and that I can do later on. I'm gonna continue, and then we can discuss further. What I then did was, of course, some robustness tests to sort of like give a little bit of legitimacy to the strategy, and of course, those are some standard ones in there. I did sub periods of a 60 and 40 split of the time span. I did change the construction window. In the default case, it's 30 days, as I showed you guys before, and I changed it to 60 and 90 days. I did different kinds of return measures. I skipped the day, and I also did just a normal momentum strategy so we can see what the returns are there, right? And those are also all three-factor alphas again, and percent net of transaction costs of the long-short portfolio. So we're always talking about this long-short portfolio. And the strategy remains, or the alphas remain significant most of the time, which is actually quite encouraging. What I mentioned before, I also did the normal prospect theory and not the cumulative prospect theory. I did not report those results because to me they didn't really add anything because the results are in the same range as for the cumulative prospect theory. I did, however, mention it in the paper. Then what I did is I included some controls in a regression analysis. So I regressed returns on the prospect theory value and then a set of controls. And every column here is it's a different kind of control introduced to the regression, right? As this is normally done. And then the most encouraging thing here is that the coefficient of the prospect theory value remains significant, even when you include controls, and it is negative. This is to tie into the hypothesis that the prospect theory value predicts subsequent cryptocurrency returns with a negative sign. And so what I then did, I dug a little.
Alex, show the previous table again.
Yes.
So there it looks like the more you add in the regression, the stronger is the prospect theory effect.
Yes. It's mostly strange that even if you include skewness, it doesn't really change, it gets stronger.
Right.
And I really don't have any explanation for that. I did run robust standard errors and everything. So I clustered everything along 2 dimensions, and still, what is most interesting is that even if you include skewness, the results stay significant.
So sorry. So what are these other variables you add? How are they computed?
Yes, this I can best show here. So the variables I have, of course, are returns. Return is the daily log return in excess of the market. Then momentum is the cumulative excess return over the last 30 days. Size, the market capitalization. Beta is the beta of the cryptocurrency over the last 30 days, stated by the one-factor model we saw before. Volume is the average daily dollar trading volume, and SDVol is the standard deviation of that. ILIC is the illiquidity measure. Skewness and kurtosis, of course, third and fourth moment. Min and max is the minimum and maximum return of the last 30 days. So the highest and the lowest return. And SD is the standard deviation of the daily excess returns.
And the mean doesn't seem too big to you?
The return. You mean the return at the mean?
The average of the column mean is what? When you say the mean of min is what?
The mean
0.22 means what?
Yes.
What does it mean?
So that's 22 on average. The minimum, the smallest return in a 30-day look back is minus 22%. This is the absolute number.
Oh, so you remove the sign.
Yeah, I removed the sign.
Oh,
yes.
okay. Yeah. Okay. Yeah.
Sorry. Yeah, I'm sorry.
Now so the volume and the standard deviation, that's computed over what period?
It's 30 days. The
So that's in
period
each case it's over the previous 30 days.
Yes, I did that the same, and analog to Barberis, they calculate everything also over the same period back.
Yeah. Okay.
I think what's also very interesting is when you look at when you do sort of like the D-cell portfolios and you do the characteristics of those. This means that you build portfolios, D-cell portfolios, based on the PV value, right? You sort them, and after that you sort them again based on the value of the variable you want to look at. So you do sort of a double sort, so to speak. So it goes from low prospect theory value to high prospect theory value, right? And as I said before, from theory we know that high prospect theory value assets should have high past return measures, low past volatility measures, and high past skewness measures, right? And as we can see here, return and momentum increase almost monotonically from low to high PV, whereas volatility decreases almost monotonically from low to high PV. And skewness also increases monotonically from low to high PV. So it seems that high prospect theory value cryptocurrencies are those that somehow trade off skewness, volatility, and returns optimally, that yields the highest prospect theory value. And this is sort of like at the core of the nature of the model, right? And as I mentioned before, I changed up those Tversky-Kahneman parameters that we saw before, right? And there are the standard ones here that we saw below, the alpha, the delta, the gamma, the lambda, and then I changed those up, right? I did different probability weighting parameters to change the level of distortion, and I reran the regression as before. Bless you. I reran the regression with the controls on the returns on PV and the set of controls, and I standardized the variables to make it comparable. And I changed the level of probability weighting. As you can see here, gamma and delta, I switched it up. The lower gamma delta, the higher the degree of distortion, the higher the probability weighting actually is. As we saw on the plot before, this plot here, this line here has a lower delta and gamma than this line here, and this line here, of course, this has no probability weighting, the 45-degree line. And I switched those up, right? And it can be seen that in absolute terms, the coefficient of the prospect theory value increases the higher the level, the degree of distortion is. This is also, to me, very interesting. So the more tails are overweight, so to speak, the more PV becomes significant and relevant. What I also did is I changed the parameters for loss aversion as well. I did exactly the same thing in the same fashion, right? And And it can be seen that in absolute terms, the coefficient of PV almost monotonically decreases when the level of loss aversion increases. So the more loss averse individuals are, the smaller the negative effect of PV on subsequent returns. This I found quite puzzling, actually. Also, this was not what I was expecting, but it was interesting nonetheless. I reported that in the paper. This was also a comment of someone in the last presentation. I think it was Thorsten. Also very thankful for that. Yeah, so as a conclusion, so to speak, it can be seen that Barberis showed that their model has predictive power for stocks' future returns, right? And albeit not working for fiat currencies, it does have predictive power in my analysis for cryptocurrencies. And I showed that the prospect theory value of a cryptocurrency predicts future returns with a negative sign, as we can see in the analysis, and that the cryptocurrency investors mentally represent the return distribution of a cryptocurrency when they look at the price chart, for instance, on CoinMarketCap or other information sites, and then they evaluate this distribution in a way described by prospect theory. And investors favor high over low prospect theory value cryptocurrencies, and this leads to high prospect theory value cryptocurrencies being overbought and thus earning low subsequent returns, and vice versa. And it seems that skewness plays an important role in analyzing of PV for predicting future returns. Yeah, so this was the rundown of the third paper. As you can see, it's a little bit different than the first two papers. The first two papers are more revolved around PPP deviations and the real effective exchange rate. And my third work was more behavioral finance driven and adopted a simple prospect theory model, and it was more like in the sense of portfolio management. And it covered the still, I think, for me at least, the still under-researched cryptocurrency market. I mean, before 5 o'clock, I had a discussion with Thorsten. There are all those kinds of new markets coming up with the internet, and I think those are very interesting markets for research, and they are to some extent under-researched. We had it about the gaming market and how transactions are priced in game, right? Something that Tim Klaus is looking into, and I think this is also an under-researched new market that I think provides a further alley for research. And with the rear, what I found most interesting is that it reacts differently to shocks depending on where the rear is compared to its long-run mean. So depending on how big the deviation is, and it mostly reverts back to the long-run mean at some point. And the size of the deviation and the asymmetry, so if you are below or above the long-run mean, actually play a role, right? And that all this can be tied to portfolio, or not all this, but it could be explained to some extent to portfolio flows. So when a shock occurs on top of an already existing deviation, investors invest and buy debt securities. So this is the story of the macro hedge fund, right? And as we just saw now, that cryptocurrencies suffer from a lack of fundamental data, right? And in the last couple of months, they only just started to be traded by institutional investors. So it's a market that is mostly driven by individual investors, small investors, retail investors, however you want to call it, the GameStop era, right? So market and sentiment factors ought to work better under these circumstances. And it just does of no surprise to me that this simple prospectory model that mimics the way investors mentally process this visual cryptocurrency data is able to outperform the market quite significantly. And it does so by assessing cryptocurrencies and predict what currencies are appealing to investors and what not, and then invest accordingly, right? So, this is the overall conclusion. I don't know, Thorsten, do you want to take over, ask something, say something now?
Yes, I think you should have some discussion, right?
Yes, please.
So I've seen you presenting this paper, and I'm happy that you took up the suggestions which we made in the last presentation. So it's hard to ask more questions, but maybe one on the economic significance. So one thing is to show regression tables with statistical significance, but then the question is, what is the economic significance? For example, are you able to implement an investment strategy, and how much return would it generate subtracting transaction costs for the economic significance?
Yeah, so let's start with the portfolio management view. I think this is a strategy that if I had the time to implement it, I would implement for myself and run it for myself, actually. The significance is, or the hurdle here is that you would actually need to have access to all those exchanges via an API, and that you have to trade quite often, right? Because you rebalance it daily. So I don't think it's something that is feasible if you want to do it by hand. So you would have to sort of like build all those APIs to 10, 20 or 30 exchanges, because not all those currencies run on all exchanges, right?
Right.
This is one of the most biggest challenges when you want to implement this, and this will take some time. And then you would also need to do some minimum investment, because if you want to trade on all those exchanges, you need to have some sort of minimum investment or money placed on all those investment accounts. So, but I would actually do it myself. So the return expectation would actually be what I presented to you in the decile analysis. I would do a long short portfolio, and I would actually expect around 5% daily, right? Net of transaction costs.
So then I'll invest with you.
Yeah, me too.
Yes. So this is So this is what I came up with, and as of now, this is the best information I have, and I base my statement on this kind of information I have, right? Maybe I can update my information at some point, and then I make another statement. But given my current level of knowledge, this is what I would predict. Then the economic magnitude, maybe on a higher level. It's interesting. I got into detail a little bit about the kinds of investors that invest in this market, right? And I think that you could say that this is really starting to become a different kind of investment market. I mentioned GameStop, for instance. I mean, what we saw there was people. I don't want to say colluding, right? But they discussed on Reddit pretty openly what they want to do in the next couple of hours, and then they drove up the price accordingly, right? And those are investors, or those are, I wouldn't say that investors, those are traders or gamblers that really invest without the analysis of any kind of data regarding those stocks, right? They didn't invest in GameStop or in AMC because it's a sound business, right? We all know that those two stocks that are basically of companies that really are bankrupt or close to bankruptcy. GameStop is certainly not doing fine. They had a stock price of $3 in March and April, and AMC, the cinema chain, as well, right? So they really just don't care about any kind of fundamental data. They invest based on other kinds of principles. For instance, collusion, or they wanna squeeze out the short squeezers, so to speak, right? It's a war against the hedge funds. And I think in this cryptocurrency market, we can see it as well. Due to the lack of fundamental data, there were other kinds of things people used when placing their investments, and they saw all those high returns of cryptocurrencies. And every day they went online and they saw, okay, Bitcoin now went up 5% again, Bitcoin went up 10% again. At one point, it becomes a little bit of FOMO, right? Fear of missing out and hurting. So then they just analyze all those charts and see, okay, this is going up fast, I want to go in too. And then they invest what seems appealing to them, right?
But your story, at least your regressions would show it's a reversal strategy which you need to do, right? Because
Yes.
the PV effect was negative, but if I look at the chart of Bitcoin during that period, it looks not like reverting, it looks like a huge rocket which is bubbling, right?
Yeah, I mean, I'm not making a statement on Bitcoin specifically. I'm making a statement on a portfolio that consists of over 130 cryptocurrencies.
I know, but the beta of all the others to Bitcoin is quite high.
Yeah, the beta varies. The beta or the correlation varies itself, of course. Now it's getting stronger again. And it's also the beta is also differently in downtimes as it is when the market is in downtimes or in uptimes, right? But I get your point. Yes. So what you could do is actually you could go long, or so the statement is that the prices rise and then they sort of like revert back again on the next, right? So maybe you can do it like both ways. So you go with the momentum on the day itself, and then you revert back on the next day, right? But on that, the statement was always on average on the cross section. What happens, right? I mean, those currencies are very volatile, and this means they don't only go up, they go down as well. And yes, when you think that Bitcoin goes up every day, I would say this is actually not true when you look at it. There are significant downtime days, right? Today it went down again. The day before yesterday it went down 8%.
So sorry, you might have shown it and I might have missed it, but if I just do an equally weighted portfolio of all the currencies, how well does that do, or evaluated?
Yeah, so the equal weighted portfolio would sort of like be the mean return of the entire sample, right? I showed that. That's actually minus 0.4% daily of the entire. That's equal.
Well, I mean, okay, what you're giving me now that's the average return that's the average of all the data points in your database, right?
Mm-hmm.
That's not the same as an equally weighted return, because the number of currencies changes over time. I mean, currencies, the number of things changes over time.
You mean of the strategy?
No, I'm saying you're showing us these 10 buckets.
Yeah.
Okay. What I'm saying is, if on a given day, if every day I just hold all the currencies, then how do the returns look? Equally weighted and evaluated.
To me, this is the same as I told you before, the mean return of all the data points in the sample.
No, it's not. Because if say you have 2 months, in the first month you have 10 tokens or whatever you call them, and in the second month you have 1,000, and if you just do the simple average of the sample, it's essentially the second month.
Okay, yeah, I get it, what you mean. Yes, I don't have that number at hand, but I can give it to you later.
But I think for comparison, I'm just saying given, because the same issue arises when you do value-weighted in the different buckets, right? Because the buckets are not the same size in terms of market cap. You know, I'm just trying I'm just asking, how big of an edge does your strategy have over just buying value-weighted?
Just going long, value-weighted everything.
Yeah.
Okay. Yeah. What I'm doing is I'm subtracting the market return. So those are all excess returns, and the market return is value-weighted.
Okay.
So the numbers I show you are already excess of the market return, which is value-weighted. Maybe this gives you a little bit of an indication.
Yeah. Okay.
What I think would also be a great further thing to do is if I change up the definition of a day. So a day would not be 24 hours in a let's say in a real world sense, right? Because we don't have like closing hours of the exchanges. The exchanges run 24/7. I could define a day and therefore a data point as when a certain trading volume is reached. So on days where there's a lot of trading, it could be that a 24-hour day actually features 2 data points, and it has then, of course, 2 daily, sort of like daily returns, whereas other days where there is low trading volume, this would sort of like give a data point that spans over more than 24 hours. This would be very interesting to do as well, right? But yeah.
And also a day is different depending on where you sit on the globe, right?
Yes, yeah, exactly. This makes the case even stronger.
Right.
If I could do trading, volume. I could do it, but there are also other ideas, right? So I think this is also something that people experiment with. I could do, for instance, what number of trades would also be, or I could define I could do it every 1,000 trades. I say, okay, now I calculate the return, right? But I think the trading volume would make sense for the cryptocurrency market here.
I think Carl had a question, right?
Yeah. So, do you have is there any survivorship bias potentially? Is there any cryptocurrencies that may have died and therefore you don't have them in the portfolio and they skew the results?
I did look at that, and I included in my data set all active and defunct cryptocurrencies that no longer have data because they died, for instance. And then the return is automatically minus 100%.
Okay, good. In order to not to worry about that there's some crazies like Elon Musk getting into Bitcoin or whatever, or the GameStop Robinhood saga, it would be really interesting to see how stable this is if instead of 130 currencies, you take out the top 3, the top 10, the top 20. But you know that. In order to implement this, is there anyone on the globe who currently could implement it? Do we know of any players, whether it's in the US, in China, or in Zug?
I think
that
guys
that have to all the necessary exchanges.
I think guys, hedge funds or quants that have a little bit more time and budget than I do, and have the necessary IT skills to sort of like make all those APIs to 20 or 30 exchanges, they could certainly implement this. And you just need to have sort of like an automated strategy in a sense that you make it so that you get the price data in, and then you instantly calculate the value, and then you send buy and sell orders out automatically via the API, and then you have to have APIs to the exchanges that allow automated trading. Not all exchanges allow that, only when you have a certain amount of money deposited with them. There are certain levels of memberships with those exchanges, right? Based on your level of profession as that you have as a trader. It's also depending on the deposits that you make, the size of the deposits. So you would need to run a little bit of a more professional organization than I can do on my own at my home. But that's the only reason I'm not running it. I'm not saying that I'm not running it because I don't think it's going to work in real life. I think it would work in real life. I just lack the means to really do it properly, right? Because I cannot stay awake all night and in the night do all those reshuffling and trade like 1,300 currencies on 30 different exchanges. It's just not feasible.
Oh, yeah.
I mean, for 5% today, I'd probably be willing to do it if I didn't have concerns about this whole area in the first place. But
yeah.
So how is the liquidity actually for these things?
Okay.
The market liquidity, right? It of course depends a lot on the size of the currency. There are also currencies that are part of a decentralized finance protocol that actually creates liquidity on its own. So there are currencies that have an elaborate incentive scheme built into it that create market liquidity because people can stake those cryptocurrencies. This is a bit different than traditional stock markets, where you have maybe the most extreme cases a market maker that brings in liquidity, right? I mean a specific organization that is tasked with bringing in liquidity on a specific stock. And the most liquid currencies are the big ones in terms of market capitalization and trading volume, and the ones that are traded on big exchanges. So that they're like the 10 biggest exchanges, all the currencies that are traded there, they are quite liquid actually. So if you have any concerns of if you go big into this, when you do the biggest ones, you probably won't have a market impact when you might make buy or sell. But this is, of course, certainly something you have to think of when you invest in the smaller ones. And my hope here is, of course, that as this entire space maturates and gets more legit and more institutional investors come into it, of course, the liquidity increases automatically also for the smaller coins, and therefore price impact of one person should become smaller.
But how big is the spread?
The bid-ask spread.
Yeah.
I don't have it on top of my head. I don't know it by heart, but I think it's for the most liquid currencies, it's comparable to stocks, and really there's also, maybe that's interesting to you, there's also some cross-exchange spreads. So for instance, Bitcoin, US dollar trades differently or quite differently than on one exchange compared to the other, right? So you could think, okay, I could do maybe cross-exchange arbitrage or something. And there's a vast literature on this actually, or people who have tried it. I don't know the success of it. Maybe there are people doing it right now. I just know that 2 or 3 years ago, we discussed it with Lucius. I don't think Lucius is here. And then the problem was always that the transaction costs made it like impossible to really take out any profit. But there was a large cross-exchange spread in the prices.
Okay, I think we have to close. Is there any urgent question? Alex, you had enough questions, maybe Isabella or Reto.
Are you telling me I should shut up?
Yes, please.
Okay.
I
No,
have to
I'm
go
done.
to another presentation.
Yeah.
Okay, Carl, how do we do with the grade?
There's some paperwork we need to fill out. Do you have that for us, Alex?
No, I don't. Alex, do you have this?
Yes, I have it. I will have to send it to you.
Yes,
Okay.
and then we put in a grade and a signature, and then send it to the dean's office. So the
Yes.
dean's card.
Do you wanna talk, the three of us? Do we need to like go in a different meeting room, or how do you want to do it?
Not to
Well,
me.
you just kick the others out. It's much easier than doing another meeting. Okay.
But
Yeah.
it's recorded on YouTube, right? If we discuss the
Okay.
grade, then it's on
Yes.
YouTube.
So no, yeah. So
What?
we have the option to kick out everyone and do a private discussion
Yes.
of the three of us, but I believe Thorsten is suggesting that we don't need that, and I agree. So congratulations for passing this, and Thorsten and I will worry about the exam, the grade later.
Right.
All right.
Okay.
Perfect.
Great.
So
Perfect.
thanks.
That's good news, actually.
Yes, now you should play the guitar.
No,
Congratulations.
thank you very much. No, I cannot play the guitar, right?
We should do the following, actually. We should make an Auflage. Ja, die Auflage ist, dass Alex nur den Doktor kriegt, wenn er das Ganze implementiert und uns als erste Investoren reinnimmt.
Ja, genau.
Alle 6, die hier sind.
Okay, but I need the help of Alex Ziegler for that. He is the master in quant strategy.
The thing is, I would probably ask for some credit guarantee or something.
Okay, yeah.
Before investing in something like that. So.
Okay.
Okay, have to leave. Bye bye.
Okay, congratulations.
Thank you.
Alles super.
Okay, gratuliere. Tschüss.
Merci. Tschüss.
Yeah,
Ciao.
congrats.